My name's Louis and welcome to my channel. I don't see a lot of young people talking about finances, and I think it's such an important topic to be able to become financially free, empowered and independent. So if you have little to no knowledge about investing your money and you want to learn how to start investing, this video is for you. I'm going to start by sharing some important steps to take before we can start investing. Then we focus on investment jargon for those that don't have any knowledge of financial terminology. I'll also be talking about steps that you can take immediately to make your money work for you. At the end, we'll talk about individual stocks and how this can make your money grow much faster than any other investment. So make sure you stay until the end to get the most out of this video. Before we go ahead, please consider subscribing to my channel, like this video and share it with your friends and family. So first and foremost, it's really important to have an emergency fund in place. It's a good rule of thumb to have at least 1 month of living expenses saved up in a savings account and steadily work your way up to 3 to 6 months worth of living expenses. This will give you a safety net to fall back on because we never know what can happen. We are literally living in a pandemic, and if it's one thing that COVID showed us is that life is unpredictable and you can lose your income at any time. The second thing we need to do is to pay off debt, especially high interest rate debt, because this can set us back in the long term. So it's very important to eliminate any high interest rate debt before you start making big investments. This is mostly consumer debt that I'm talking about, and it can be credit cards and personal loans, and it usually has quite high interest rates. The third step is to open a retirement account. In South Africa, this is known as a government employee pension fund, and this is what you invest in when you are employed. In short, it's a fund that invests in 4 different asset classes, which are equities, bonds, property and cash. The sooner you can start contributing to this fund, the better. If you are self-employed, you can invest in a retirement annuity instead, which basically means that the investor owns the investment outright and is not connected to the employment status. With that said, let's break down some of the investment terms. So if you are unfamiliar with terms like stocks, bonds, the stock market, diversification, etc., I'll try to explain to you guys in as simple way as possible what these mean. A stock is an investment that represents a share in a company. So let's say, for example, you invest in a stock like Coca-Cola, and if the company's revenue grows, this will mean that the stock price will go up and your share price will increase. The stock market is a marketplace for stocks where shares of companies are being traded. The stock market is a generic term for all the markets around the world, and it shows how the companies are performing and how they are being traded. The interesting thing is that the stock market is mainly controlled by investors' emotion. Fear and greed drives the stock market. Let's say, for example, Facebook is being sued for data privacy issues. This will spook investors and that will cause them to sell their shares, and that will cause the share price to go down. The same thing for when there's good news all over. Investors will start to get greedy and invest as much as possible, which will result in a share price that rises. Diversification is a very popular term, which basically means protecting yourself from economic downfalls by diversifying your investments. This basically means instead of putting all of your eggs in one basket, you spread them out over different asset classes and different industries. Risk and reward is a term that we hear a lot, and this basically means the reward that you will get for every dollar or rand that you invest or risk. You will hear people saying things like, the higher the risk, the higher the reward. And that might be true, but there's lower risk investment options as well. And this is where bonds come in. A bond is a loan to a company or to a government that pays you a fixed rate, also known as a coupon rate, over a certain amount of time. This is generally a much safer way to invest because you are technically guaranteed your coupon rate each and every month, as well as your initial investment at the end of the loan term. Investment funds are basically a basket of investments. Imagine this: when buying a stock, you are buying one flower, and when buying an investment fund, you are buying a bunch of different flowers. Today we'll talk about mutual funds and index funds. A mutual fund is an investment vehicle that consists of different securities like stocks and bonds. They are generally managed by portfolio managers that are really smart and really educated. They actively manage this portfolio to grow your investment as big as possible, and they basically take a management fee every year, which usually ranges from 0.25% to 2%. So it's important to be aware of these fees because it can make a dent in your investment. Index fund is also a fund, but it's not actively managed, and instead it's a passive way of making money. The strategy of an index fund is to track the market instead of trying to beat the market like mutual funds. Warren Buffett once made $1 million bet that over a decade index funds will outperform any active mutual fund, and he actually won the bet. This shows you that no matter how smart you are, you will never be able to beat the market consistently over a long period of time. This makes index funds the best and easiest way to invest. This is an investment vehicle that has become really popular over the last couple of years, and it's such an easy way to start investing, and the barrier for entry is much lower than investing in a mutual fund. For most people, this would be the best way to start investing, and basically you can invest into an index fund every month, or you can invest a lump sum once off and never touch that money. Like I said earlier, it's really important to start with the first steps before you can start investing. By doing this, you will build a good foundation. From there, you can decide on your strategy and the amount of risk that you want to take on. Some people will prefer the higher risk and higher reward strategy, and this is perfect for people that are still young and have a lot of time on their side. This means that you can invest in individual stocks, and this requires specialized knowledge, so you need to understand how to analyze companies and how individual stocks actually work. There's ways to make calculated risk to cover the downside. That means that you have a bigger margin of safety when investing, but there will always be risk involved when investing in individual stocks. This is definitely a more hands-on approach and can be a tedious process when you are just starting out. Other people will consider taking the slower and lower risk approach, and this is basically investing in index funds. You've probably heard of the S&P 500, the Dow Jones, or the Nasdaq. These are great funds to invest in. You can invest in a fund like Signia or Satrix that basically tracks the S&P 500. When following this strategy, you can basically invest your money in one of these funds and sit back and let time do its thing. The best time to start investing was 20 years ago, and if not then, today is the best time. So let's talk a bit about investing in individual stocks. It requires specialized knowledge to understand how you can invest in a company. You need to be able to understand financial statements, how to analyze income statements, how to read balance sheets, and understand cash flow statements. This is information that a company will share with the public each and every year and each and every quarter that the investor can use to analyze the company's position, and they can decide from there whether they want to invest in the company or not. There's certain ratios that we can use as investors to determine whether this is a good investment, and we can compare the one company to a company in the same industry. These are like PE ratios, earnings per share, price to debt ratio, free cash flow to debt ratio, etc. There's hundreds of ratios that we can use to analyze deals, and this will give us an indication whether we should invest in a company or not. This is, however, only indications and is heavily dependent on the numbers that you use, so it's so easy to make a miscalculation which can cause you to lose money. You can use platforms like Easy Equities to invest in shares and invest in different funds, and I'll share a link down in the description that you can use to register on the Easy Equities platform, and this will give you a 50 Rand voucher to start investing with. If you don't like Easy Equities, you can use your local bank's investment platform, but just be aware that the fees usually are much higher. It's important to understand that everything that I'm saying is for entertainment purposes only, and I'm not a financial advisor, and it's important that you should do your own research to make sure that you understand the information. With that said, I hope you guys enjoyed this video and it helped you to understand the basics of investing. Hopefully you can start investing as soon as possible and realize great returns. If you like this video, please subscribe to my channel, share it with your friends and family, and I'll see you guys in the next one.